Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world. Hello there. Hope you're doing okay following the election here in the U.S. A bit of a pall of gloom over Chicagoans, to be honest, even with those U.S. markets screaming higher the day after the polls close. But anyway, hang in there, or don't celebrate too much depending on your side of the vote. It's usually never as bad or as good as it seems. On to this episode where we chat with David Sun, who went from retail options trader to running a small fund. David has some interesting takes on how and why he approaches options trading and zero DTE the way that he does, including the idea of whether he'd be better off not learning any more about it for fear of removing what makes him different than others. That's a new one. David talks about his custom metrics for measuring the risk-return profile, use of stop losses, and we debate whether volatility risk premium is an edge or just a factor, whether it even matters. Send it! This episode is brought to you by RCM's Managed Futures Group. Looking at vol traders like David or emerging managers like David? He's a bit of both. Question about why one program or another performed the way it did? Give our team of specialists a call and get the inside scoop on dozens of funds and CTAs we work with. Visit rcmalts.com to learn more. Now back to the show. All right, everybody. We're here with David Sun. David, how are you?
Hey, I'm good, Jeff. Thanks for having me on.
Yeah. David is entrepreneur slash trader slash fund manager slash podcast host, wearing a lot of hats.
Yeah,
You have the most common Zoom background, but you're not actually in the Bay Area, right?
that's correct. Yeah, I'm on the East Coast. I usually have the outer space one, but then people always joke, "Oh, you're calling from space," but
Love it. Where are you in East Coast?
I'm near the capital in Virginia.
All right. So let's start you kind of have a unique entree into this space, having been a retail trader basically before you started doing it professionally. So talk a little bit about that journey if you could, and what made you think you could do this for real?
Yeah, sure. So I don't have any formal finance background, education, or pedigree, if you will. Actually, my background's in electrical engineering. I was doing my master's at Princeton. This was around 2008, 2009. So interestingly, even if you weren't into finance, right? The market was probably on your mind around that time during the
Definitely.
GFC. So I just kind of thought I might get into trading stocks, and not I had no idea what I was doing. I was watching Mad Money, Jim Cramer, and
Oh boy.
and just just picking random stocks. And so I had a friend there that in Princeton that knew about options, and he was like, "Why don't you try options?" So the interesting thing is, like, so I got into options very early, right? I didn't really do a lot of stock trading or day trading, if you will. And not only that, he got me into options through the idea of selling options. So I didn't have that first step that people usually make the mistake. We're buying options and trying to make big bets, leverage bets, and and fighting theta and all that. So selling put writing was basically what I started with. Now, granted, there was not really anything scientific back then either. It was
Yeah.
literally, okay, instead of picking the 5 stocks that Kramer talks about on on Mad Money, sell puts on those, and super naive, just looking at the option chain, selling the monthly, and being like, oh, you can get 1% for a month, and okay, if I just do it 12 times, and if I roll it when I'm challenged, you get 12%, and it seemed easy and
Good time to be selling puts after the crash.
a good time to be selling puts. So of course it worked for a couple of years, made a decent return. But again, like eventually the market turns, and things kind of I didn't blow up, but it was like, oh, this is not so easy. So kind of took a little bit of a break just because it was like I think I bought my first house, so I took some money out. But at my I had a friend who he knew I was into options, and he actually had some money, I think was managed by like Morgan Stanley or something. I forget who it was, but he wasn't happy with how it was going. And he was like, hey, can you try to get back into this and learn again? And so we can kind of learn together. And so I was looking at a lot of different online content for, mostly retail oriented stuff, the tasty trades, the option alphas, um, and really kind of just doing a DIY, but like learning as I went, engaging with other online communities. And there's a lot of sophisticated retail traders. I know they kind of get a bad rap, especially if you look on like TikTok or YouTube, all the kind of like the trash videos and
Yeah.
if you will.
And
But
you're kind of coexisting at that time with the Wall Street bets and all that stuff too, right?
personally, I never did because I wasn't into Reddit, but I knew about that space. But so there was a lot going on, connecting with a lot of people, kind of learning and honing my craft, and just getting, finally learning the Greeks. Um, and so this was around 2017 that I kind of really found my footing. A year and a half later, you asked me about how I got the idea of starting a fund and how I thought I could do. I don't know what got into my head. It was just like, okay, I'm having some success, and it seems like if I could raise some money, I could be doing the same thing I'm doing now, just trading a larger account, right? Using other people's money and my money, and getting paid, right? Because trading is kind of like the ultimate, or just asset management is like the ultimate scalable business, right? You just
Yeah.
get more money and you get paid, and you're basically doing the same thing. I mean, maybe that's a little reductive. Obviously, there's more involved in that. But so I launched my first options based fund around late 2018. It's interesting because the timing was great. I launched October 2018, right into the next sell off. This was kind of the December 2018, right? I
Yeah.
forgot what it was. The something with what I think it was interest rate related, but Mark had a big sell off. So
Yeah, and the
uh,
volatility actually went down that December, right? So the market crashed in the mini crashed.
yeah, yeah,
Yeah.
exactly.
That was a
Um,
weird, yeah, a lot of people we've had on this podcast had a tough December of 18.
Definitely. And then 2019, another stroke of luck, market recovered, got that redemption arc, funded well. And then of course 2020 happened and COVID. And so, and then interesting, 2021 market rally, 2022. And so there was so many different market regimes that basically happened. It was like three bear markets in the space of 6 years. So it was a lot of good learning experiences, n- just enough to learn the lessons, but not so much that went under or blew up.
Yeah.
So I think the timing was very fortunate in that case, that like was able to like just get through all of these different experiences and really make the most, and get a lot of takeaways.
Yeah, and
Um,
that's always you talk to a lot of option people like, "Oh, I've tested this, right, this strategy through XYZ." You're like, "Well, how often, right? Is it statistically significant for those events that have only happened a handful of times in 40 years? Right?
yeah,
Is it
exactly.
statistically significant to test those into your model at all?
Yeah, it's hard to say because like
Better
you
to have
wanna
lived through it. Yeah.
live through it, and of course you want to test through it as well, because you kind of want to know what those periods of stress are. And I know we'll talk about probably August 5th in a little bit here, but that was just another never seen before kind of event, right? A confluence of a lot of different things. But just to kind of finish the story, so 2021, we spun out one of our strategies. We're just focused on zero DTE SPX, and we just made a kind of a zero DTE focused fund. And that was 2021. So I've been running two funds since then, and then here we are now, 5.5 years later.
Take me a little bit through that. Like, so there surely was some nervousness there, right? Of like managing other people's money, or did you were fine with that mentally, right? I think it is ultimately scalable. It is an easy transition. Instead of doing two contracts or doing 22, whatever the case might be, but a lot of people can't handle the mental anguish, right? Of like, oh, I just lost $10,000 for my uncle or whatever the case might be. Like, how did that work out with you? You were fine with it?
I'm either super naive or overconfident, but the way it played out, we started with, I seeded it with my personal capital, and it was very little other people's money at first.
Hmm.
I kind of did the thing where I had an incubator set up, but then I felt like a track record with real, LP funds, even if it's
Yeah.
a little, it's kind of different than an incubator track record with just my own money. I don't know, it just feels different. So I went ahead and launched. I was basically not covering my expenses. I was paying out of pocket, right? And that was
Yeah.
the case for 2+ years. And so I guess there wasn't a lot of other people's money to like be worried about, I guess. And it was mostly just grinding, trying to trade the strategies and still capital raising at the same time. And it's kind of the typical, you hear about a new business, right? The 3-year trajectory is like a 2 or 3 year grind until you kind of hit that escape velocity and actually get enough funds to first cover your costs and be profitable. And then kind of just it just took off from there. So again, maybe just kind of that timing aspect, it just worked out that way. I was able to kind of get through the lessons without having too much other people to worry about and getting calls and stuff. And I found my footing, and then everything kind of just worked out that way.
What would your advice be to other people trying to do the same thing? Don't quit their day job. Keep a funding source on the side and then let this grow. And when it hits, it hits.
I would say that definitely helps. If you have the luxury of some kind of job that has flexibility, and if you're gonna be trading, like it depends on what you're doing. If you're day trading, you have to watch a screen. That's totally different. But we're mainly automated, systematic trading. So during the day, there isn't much. No, we're not watching a screen per se. Like if there's some kind of risk we gotta manage, we'll get an alert or something. But other than that, I think most of the work was like asynchronous to the market hours. It's back testing, doing research, setting up calls or whatever.
Yeah, yeah.
So you can manage that. But I think if you have to depend on your fees as your sole income, it's gonna like lend kind of this. I don't know. You never want to be desperate, but like you have to make profits
Yeah,
to feed yourself because that's gonna change how you approach your trading. And so much of trading
exactly.
success is based on conviction and discipline. And so you have to be able to manage those emotions. And it's not going to help if you've got this other thing like, hey, like I need this, need this gain, or else I'm not gonna be able to
Can't pay
afford
for the
that or whatever.
wedding or whatever. Right.
Yeah.
The and what was that? So you said at Princeton, what was your education in? So it wasn't in quantitative finance. What was it in?
No, it's electrical engineering, so
All right.
nothing to do with
Cool.
finance. But I always say at the very least, I got a good grounding in math, which helps, right? Because what we do is all kind of, it's funny. Like I say, you don't even need to know calculus if you know algebra and you have kind of some basic statistical foundations and probability and just not really even super complicated stuff. Like you can do this job.
Yeah. It's fun. I should actually go back and count how many, but so many managers and traders on the podcast who came out of engineering, either electrical actually is itself or just general engineering, because I think their brains think of the market as a problem, right? And like if
Right.
we can just build the solution to fix that problem, I'll often argue like, are you sure it's a solvable problem? Right? It might be an illusion of it's a solvable problem. What do you think about that? Do you think it's ultimately solvable, or you're just trying to exist in a semi-solved state?
I think that goes to the idea of knowing if you have an edge. I always say like when you're trading, right? Ultimately, you just have to take what the market gives, and your job is just a risk manager. And so this is also related to developing strategies and back testing. And people talk about curve fitting and whether or not you're just fooled by randomness. That's what I thought of when he said, "Is it a solvable problem?" Or you're fooled by
Yeah,
randomness, right?
right.
And the idea is, I think there's some core principles. Like we rely a lot on with options is volatility risk premium, and there's a lot of literature and reasons why that exists, right? But you have to fundamentally believe that there is some edge in overpricing of options. Now that can be used on the sell side or the buy side. And then there's, whether or not there's equity risk premium or positive drift, right? Market go up long term, right? You take advantage of that. And then of course, like factors like momentum and trend, which ultimately I think go back to behavioral biases, where there's reasons for that momentum and trend exist that's rooted in either information not being propagated immediately, or there's emotion, people are greedy or fearful, and so they either buy too much or they sell too much. And so there's reasons and kind of drivers behind these ideas. And for us, we always want to distill our strategy back to, we believe there's this edge here. So when we say solve the problem, right, we're not trying to create some additional source of edge that's like not known, but we're just trying to kind of manage our risk, right? Develop strategies that can take advantage and harness those edges without taking on, huge risk. And so solving the problem is really just surviving. I guess that's what it comes down to. If you can
Yeah.
survive, then that's for us is solving the problem.
But would you call VRP and momentum and those edges, or are those just factors, right? They're just
Um, I guess, you know, this may be partially due to the fact that I don't have that formal background, but for me, like, how would you differentiate those two? At the end of the day, there's some concept or some reason why there is a business model or some driver of the profit, right? So
yeah.
maybe I'm not using the term correctly, but like that's
Well,
kind of how I
yeah.
think of it.
Well, then that would be a factor. Like this ability to take this risk and make this money is driven by this factor, which, right, volatility risk premium, right? The fact that options tend to decay into expiration isn't an edge, so to speak, right? That's nothing. It's well known. It's all over
Sure.
everyone's no, right? So that would be my difference. Like an edge is I'm at a prop firm here in Chicago. I've got better technology. I can put big bids and offers in on small options that retail can't match. And right, I'm front running and all that stuff. That's an actual edge where they have either pricing or information or technology edge, right? Or in trading it, right? If I'm a hog trader and I know that right, with all my contacts, I know that the supply is going to be lesser than what comes out in the news or something of that nature. That's an edge, right?
One thing that reminds me of though, so I've heard there's kind of four sources of edge, right? There's informational, as you mentioned, you have some information that nobody else has.
Yeah.
There's analytical, where you have the same information, but you're able to analyze it in a way that's different or better. There's sort of technical or, like I said, execution, where you can
Yeah.
just do that thing better or faster. But the last thing is kind of behavioral. And basically, if you kind of know there's certain tendencies for humans to react a certain way, and maybe that's, related to like market flow, for instance. If you know there's behavioral biases, you can take advantage of that. But as I mentioned, I think that in of itself is kind of related to VRP and even momentum and trend. So maybe that's why I kind of conflate the two. Like, is that an edge
Yeah.
or a
Yeah.
factor? So that's what I'm kind of getting at, yeah, or
Yeah. I
how I
could
see it.
sort of agree with that, right? Of like the act BRP itself isn't an edge. To be able to trade it and not blow out, that could be an edge, right? Like that's what you're saying. The behavioral, the structural, like to be able to risk manage that factor could be the edge.
Right, right.
Let's dive into the models a little bit, to the strategy. So, as you mentioned, you went through all those different periods, those three market quote unquote crashes or downturns in short period of time. You started from an option seller, and then did you morph into more protection or different sides of the trade? How did it morph from like pure premium
Yeah,
seller
we
to what you're
we
doing now?
we morphed into more protection and even into more buying. So we kind of sell and buy depending on what we're trying to capture. But just to go to the beginning, like in the beginning, when I was thinking of just the idea of overpriced options, right, and trying to capture that, the very basic strategy was just selling puts, right? A lot of people do that, and one thing we started with was just selling weekly, 7 DTE puts at I think it was like a 15 delta, and just sell those puts. And at first, I kind of was thinking, hey, as long as you size it small enough, if you don't manage these, you can just sell them. And yes, you don't want to go so much that the market goes down 10% and you blow up. But the idea that if you can sell the puts, you're going to collect that VRP over the long term, right? So there's a terminal positive expectancy, not accounting for the path, right? Obviously, you can have
Yeah.
drawdowns and such. But
Right, because some
like I
would
said,
argue, sorry, I interrupt you, that the
yeah,
selling of puts is terminal break even, right? That you could make 100% over 10 years and then lose it all in the 11th year. So you're saying you could model it to say there is some positive
I
expected.
I think at a certain out of the money range, there is a certain amount of terminal, uh, uh, what one term I use is called premium capture or PCR. Basically, if I for every $100 that I sell in premium, how much do I net at the end of the day, net of
Mm-hmm.
all the losses in the money, stop loss, whatever it is. So I tend to think the PCR at a, let's call it a 10 to 15 delta range is going to be a little higher than kind of like at the money. If you're just selling straddles, I don't think there's going to be that much that you expect to gain or lose buying or selling. But as you said, 2018 happened, drawdowns were large, and so we're like, look, we have to manage risk, and we just use a simple idea of a stop loss. I know there's a lot of debate and a lot of controversy over stop losses, especially dealing with options and
Yeah.
execution, all that. But I mean, we can get into that in a bit. But just if we just think about it this way, if I sell an option, my max profit is the credit, right? And so there's going to be a certain win rate. And if you sell 15 delta, it's probably going to be like 80, 85%, for instance. But if your losses are too big, right, even if your terminal win rate is or expectancy is positive, like you can't scale that strategy because you're just going to have drawdowns that you can't overcome. And it's just too risky. And so
Yeah.
if I do a simple, let's just call it stop out at 2x, right? So if I'm collecting $100, I'm gonna stop out if I'm challenged and the option is selling for 3, right? If it's tripled in price and I close it out, so I collected 1, I closed it for 3, buy to close, my net loss is 2. So
Yeah.
I'm using a simple number. I've risked 2 to make 1. And if you use a stop loss, your win rate is going to go down. This is known, and this is another reason why people argue against that. But the idea here is when we model expectancy, you have 3 variables: your win rate, which a lot of people focus on, your win size, and your loss size. I think the size of your losses is what's overlooked a lot.
Yeah.
What I tend to do is focus on the win and loss size and let the win rate be the variable. So if we go back a second, if we have no stop loss, 15 delta put, or whatever delta put, you're going to have a certain win rate. If you cap the losses, risk 2 to make 1, your win rate's going to go down, but you know your risk reward profile. So at a risk 2 to make 1, your required win rate to make money is 2/3,
Right. That's just an
66.6%.
equation. Yeah.
It's just an equation. So if you can find a strategy where you can, you know, kind of engineer that payoff profile, then all that remains is to see where the chips fall. What is that win rate? If it's high enough to be plus EV, right, then you just run that over and over again. And
Yeah.
so it
I
just
think,
becomes this. Go ahead.
yeah, so I think the argument to that would be slippage, you lose connection, all this kind of stuff of like you can't guarantee that 2-to-1 loss. You could
Exactly.
argue over time it's going to be close to it, but I
And
think
so
that's what scares people. Like, well, the stop
all
loss
of
is imperfect, so how do I rely on it?
all of those things you mentioned, you just got to bake it into your model. Right?
Yeah,
For instance, one of our strategies where you just sell S&P puts, and it's about a 90 DTE, 15 delta. Liquidity is pretty reasonable. This is not like selling intraday where you go in the money and liquidity is gone
yeah,
and all the gamma and everything, right? We sell high DT because the gamma is lower. It's more reasonable. We've looked at it, the slippage on average, let's even call it, you know, sell for a dollar, you try to buy for $3, you buy for 310 or 320, right? Like 10, 20% relative to credit. Just bake that into your assumptions, right? That's
right.
going to increase your required win rate to break even, or for the same win rate, it's going to lower your PCR. But at the end of the day, it's all an equation, and you have to bake those in. And so, like people who talk about back tests, like a lot of times back tests aren't reliable because your assumptions about the execution is wrong, right?
Yeah,
You're not modeling
especially
the
in
fees or whatever,
options. Yeah,
right? And so what we can do is we've taken our live numbers, so we know what the execution. Of course, like I said, nothing's guaranteed, but you have enough samples, you can use those to inform your modeling and make it more accurate. Um, Now, with markets being closed, they can gap.
yeah,
That's all
yeah,
baked in, right? There's been instances, for instance, August 5th, right? This
yeah,
one particular strategy, rather than 2x, we got it at 3x or 4x. That's going to raise your average loss. But once again, that just all gets baked in, and the more numbers you have, and you just have to have correct expectations and assumptions. And And we'll talk about the hedging in a second, but
Yeah.
that's where the fundamental premise. And a lot of our strategies, we have like, like a dozen strategies now, but the approach is similar in that the strategies that are using net selling of premium with risk management, we focus a lot on the statistics and the probabilities, and use that to kind of model the expectancy.
I always tell people overly focused on win rate. Like I can build you the perfect 100% win rate model right now, which is buy now, sell when profitable, right? By
Right.
definition, that'll have a 100% win rate. Can you survive it? Can you survive if it's down 98% or something? But by definition, that's a 100% win rate. But what does that do for you? So to your point, right? Like just having a great win rate, what does that really mean?
Right.
It's you have to have all the other factors. You have to have the average loss, everything else included in that calculus without doing calculus. So one part you said, hey, we got to control this calculation. We can't be losing more than whatever, 2x, 3x. You have a number there with stop losses. The second was adding some hedging.
So with longer data options, right, people kind of don't like that in the sense that, hey, this 90-day option, anything can happen in 90 days, right? So that sometimes people who want to tend towards leaning towards the shorter duration, that might be why. But as I mentioned earlier, the nice thing about a longer duration is the gamma is inherently lower, so the options move slower, all else constant, but you can reasonably hedge them with basically something that's going to react in a market drawdown, right? Like a Vega hedge, basically. Now, there's sort of the classic, back ratio, right? If I sell one, I can buy two further out of the money and establish this ratio. Now, if you look at the risk curve, there's sort of this at expiration, they call it the valley of death, where if the market kind of just lands in that zone in the spread, you're still losing,
Yeah.
but
Pin risk, another name
yeah,
for it, but yeah.
and you're relying on sort of this quick down move with volatility rising to kind of be a backstop, and that ratio will kind of pop up and kind of curb the drawdown. So that's one way to do it. We do that as well, but what we've really looked at is when we're moving to kind of shorter dated structures, it's very hard to establish a Vega hedge, right? So we have one strategy where we're selling like a daily, right? Just Monday sell for Tuesday, Tuesday sell for Wednesday, just the next expiration, right? Very short dated strangles. We still apply the stop loss, right? Same mechanic. But one thing that really kind of scared us about the shorter dated ones, where we didn't want to lean too much into it, was when you're talking about short dated options, you can't rely on a back ratio or some kind of, right? You can buy a cheap out of the money wing and just spread it off. But at distance, you're just establishing a wide credit spread. It's not really going to protect you of that. Like you said, the pin risk. The market could fall 5%. That wing's not going to do anything. You're just going to take max loss on your spread. And so one thing that we really realized was this idea of kind of flipping the script on what your hedge structure is. So earlier I mentioned you can buy further out of the money options. They're cheap, and you have some reliance and low cost, but but you also have a reliance on the path dependency, right? The market has to do a certain thing for your hedge to hedge, right?
Yeah.
For lack of better words.
But most people would think, well, and but same time, if it whatever, 80% of the time it won't do that thing and I'll be fine.
Right.
Yeah. People's
Until it
brains
does.
kind of go like, well, it'll usually land in this range and I make money. And then the 1 in 10 chance it blows all the way through that I hedge it, forgetting that there's right.
Right,
16% of the
exactly.
time it might be in between those two things.
So one thing we kind of realize is, so imagine instead of these out of the or further out of the money kind of teenies, if you will, you use a closer to the money, like think of a long at the money straddle, right? If you're long at the money straddle, you're actually long the market. You're long gamma essentially, but it's super expensive, right? So you're gonna think, well, if I'm selling an out of the money strangle for some credit, and I try to hedge it with an at the money structure, like sure I'm hedged, right? Because I'm actually long the guts now, but doesn't that cost a
Yeah.
lot, right? Because you're paying a lot, right? So it seems counterintuitive, but the interesting thing is like if you kind of think about, we did the research long term. If you just buy these at the money structures, they may not cost as much as you realize. And what I mean is this, right? This goes back to the explanation or the discussion earlier about VRP, right? If out of the money options are overpriced because people have this desire for protection and they kind of bid up protection, I think at the money options may be slightly less fairly priced, meaning the terminal expectancy is not going to be super positive or negative, as in you can buy these straddles or buy whatever near the money options, and your equity curve on that structure is going to be crazy, right? When the market moves, you make a lot. When the market doesn't move, you lose a lot. But over time, it actually is kind of wrapped around zero to slightly lower, just depending on which time frame you're looking at. And so if we go
Yeah,
back to
like a
what
way
we're
to look into that if everyone wants to hedge out of the money, so there's a slight premium there, right? Skew, they call it put skew. If nobody wants to hedge at the money because it's too expensive, there could be a little discount there. There's less of a carry, you're saying.
yes,
Highly volatile, but less of a
yes, there we go.
yeah,
Good
yeah.
description. Good word. Okay. So the highly volatile makes it undesirable, but the less of a carry, as you said, guess what? If this is the hedge, less of a carry is actually good, right? And so if we use these at the money structures, you're structurally protecting your out of the money, strategy. And it's weird because your income, your profit is from those out of the money things you're selling. And yes, it's very volatile as a package. So like combining these two, the return stream is pretty lumpy. So like if you're only doing this strategy, this kind of combo, like you're gonna basically be flat a lot of times, and then finally when the market rips, right, that hedge kind of shows some profit. So by itself is not great, but what I want to get at was thinking differently about what it means to hedge and what kind of structures you can use, especially when you have kind of an ensemble of strategies. And the other thing is uh, this concept of the term I coined was a zero EV diversifier, a sleeve of your portfolio that isn't necessarily meant to drive profits per se, but it's just meant to diversify the exposure. And
Yeah.
so what happened with that is a lot of times in our research and ideation of strategy and trying to generate new ideas, it opened up an avenue so things we might have ignored or just discounted before were suddenly opened up, right? And like all because of positive drift, right, it's so easy to find a put selling strategy and back test and it looks great, right? It's actually very hard to find a bearish strategy or something with call selling because you're always finding the market trend. But what I realized was like after some time, I don't necessarily have to find a strategy that's quote unquote bearish that makes money. If I can find something that's like kind of flattish or maybe only loses a little bit, it might be a good thing to add to the book just because it's going to be naturally anti-correlated to the rest of the book that's kind of bullish already. And as long as it's not losing a lot of money, right? It doesn't
Yeah.
need to add to my bottom line. It just needs to hedge my exposure and reduce
Yeah.
my portfolio variance.
Well, right, that's you're explaining health insurance, home insurance, right? Of like, yeah, I don't like having to pay this cost, but it's going to help my overall bottom line over time. And then in overall portfolio construction, right? We deal with this in trend following and managed futures all the time. I don't, this thing's only flat over these 3 years. I don't get it. I don't want it in my portfolio. You're like, hey, when there's an 08, when there's a 22 and it performs, you're going to be thankful it's there. If it can carry positive again, right? If you don't have to pay for that insurance, then it shows up. That's kind of the whole idea, right?
Exactly.
So
Yeah.
it's
So like
interesting, yeah, that you're doing that inside of your own strategy instead of usually that's a portfolio level concept, right? Of
exactly.
adding these pieces.
And one thing that's really helped is this idea of it's kind of like first principles thinking. We call it thinking components, right? You may have strategies and you have all these mechanics. You have a profit take or a stop loss, or you got the hedge and even you think about a typical iron butterfly, right? Like you think of it as a package, right? It's like long the guts, short the wings, or whatever. But sometimes when you strip down the pieces and think about each leg of that strategy, each transaction in a set of mechanics, you can kind of distill them down and look at them in isolation and find out what's driving the profits and what is maybe just an unnecessary drag. And then you can really strip things down and figure out and use kind of the best parts. And it's this type of thinking that lends itself to realizing different pieces have kind of different purposes, and making P&L is not always a priority, as ironic as that sounds.
No, yeah, that makes total sense to me. I just don't like it when they call them broken butterflies. That's a sad image in my mind, right?
Right.
Those poor broken butterflies. So having said that, how many of these models are in your overall strategy, right?
So right now, like, just to give an example, in the zero DTE fund, we have like 6 or 7 different strategies that are all kind of in the zero DTE space. But just to give an idea of like how they differentiate. So again, we go back to this concept of selling premium and having a risk management in place to kind of manage that risk reward profile. And so we had one strategy which was a very naive, just timed selling, puts and calls. So like literally on the hour or whatever, right? We would sell amount of premium, sell amount of premium, sell amount of premium, put a stop loss on each different entry. The reason we did that is like we tranched the entries because, interestingly, yes, we're selling SPX. They're all on the same underlying, but with zero DTE, it's such an accelerated time frame. All those entries, even the morning, the noon, and the afternoon entry, won't be as correlated as you'd imagine, right? You can literally track each different entry as a bucket and run a correlation, and it's not 100, you know.
Yeah.
Um, and another idea was,
And that's interesting because even hours apart, right?
yeah, or minutes apart, literally.
Minutes. Yeah.
And so this other idea is, because we're using risk management as far as, again, just a simple stop loss, we are kind of laser focused on the risk per unit of credit, right? So I have this phrase, credit as a proxy for risk, right? I know people talk about buying power or margin, but
Mm-hmm.
if I know that for every dollar I collect, I'm only going to risk X, then the amount of credit I collect is a proxy for the risk I'm willing to take on a given day. And so we've established what we call a credit budget. So let's say we only sell $1,000 of premium per day. That means we technically only put $2,000 at risk, right? Just for an example.
Yeah.
We'll take that $1,000 and we'll just split it among the different entries. So you take the $1,000 and 10 times, right? $100 each, for instance. And so we had this very naive strategy, and I talked about this on my episode with Corey on Flirting with Models. And back then, I literally emphasized we had no signals. We just sell on schedule, and this
Yeah.
was the This was the original one. But we've come a long way since then, because we've identified, for one, it's always out of necessity. We noticed that without any signal, the edge from more edge or factor, I know you
No
mentioned
worries.
it.
Yeah.
It was slightly less profitable. It could have been because of the proliferation of zero DT, more volume, more people selling. All these institutions, covered call funds, everyone's selling zero DT. Is that driving down their risk premium? Who knows, right? It's all speculation. But we noticed that it was like less profitable. So we try to find other ways to express this. So we realized, like, if we can just kind of increase the win rate slightly, right? When you have this kind of tight expectancy equation, win rate, win size, loss size, even incremental increases to your win rate have meaningful pickups on your expectancy or PCR, premium capture rate. So we try to find ways to, hey, let's not always be neutral, right? As in always sell a put and call. Is there a way to get an idea of the trend? And I was very opposed to this before. I was kind of like this anti technical analysis and looking at all these MACD, RSI, those kind of things. And I've come to realize, like, again, I think people call it self-fulfilling prophecies, but there's a reason for that. There is behavioral biases. There's reasons markets trend. So I was more willing to kind of look into it. And so
Yeah.
our different strategies are just different ways of, hey, instead of every on the hour sell puts and calls, we're gonna say, hey, if it's trending upwards or trending downwards, we'll lean our exposure, right? We'll only sell puts, which is bullish, or only sell calls, which is bearish. And so all of those different strategies are essentially, we have different signals informing us of the directionality and where to lean the exposure. Now they're all trend based, but and I'll give a couple examples of like how we get the trend signal, but because they're different signal sources, sometimes the signals align, right? They all fire, everything's bullish or everything's bearish. But sometimes you get mixed signals or we get different timings. And that's what you want. You don't want all your trend signals just to be one big bucket of correlated strategies again, right? So we have different strategy sleeves that, because the signal is different, one may be bearish and one which is bullish, right? Which kind of nets out, right? But the timing is different. So it's essentially trying to just be a little bit smarter about trying to follow the trend. And just an example of one thing to get a trend signal. So because our bread and butter, our expertise is the options, we're very focused on price. So we'll look at the price movement. Everything's related, right? If the market
Price of
goes
the
up,
option or price of the underlying?
price of the option, right?
Yeah.
We don't do so much of the price of the underlying, but as I mentioned, everything's related. If the market's moving up, right, the call prices are gonna be going up and expanding, right? And the price of puts, right, which are below the market, are going to be going down or collapsing. And so both of those, in fact, calls expanding, puts contracting, both can be an indicator of an uptrend, but not necessarily with the same magnitude or timing. So looking at calls expanding and puts contracting, or vice versa on a downtrend, is puts expanding and calls
Separately.
contracting.
Yeah.
Those can both give you separate signals that are slightly different flavor. And so that's something we look at the rate of expansion of the calls and the puts, and we look at, if I want to be fancy, I could say we're observing the volatility servers, but no, we don't really graph out the volatility servers. We just pick options at different parts of the chain and kind of observe their movement.
Yeah.
And we do
But you do
also
that separately. So those are two separate
we,
signals.
we do that separately.
Yeah,
Exactly. So
that's
I was trying to make a point that yes, simply saying yes, calls go up, puts go down, markets going up, but separately looking at them can give you signals of the same direction, but different timing and different magnitude. So that it's interesting that you can observe a lot of things from the chain, and just using those to, again, each strategy. So we'll take our kind of credit budget or risk budget, if you will, and let's say we have 6 strategies. Every strategy gets 1/6 of the daily credit target or credit, budget that we get. But
so that's not
they have
risk
different.
balanced in any way, or you just can assume each of the strategies has the same risk because it's using the
So
same type of stop and whatnot.
they're not equally balanced in terms of risk per se, but we look at over time the variance, because a strategy like we have one, for example, that's a little more concentrated where it takes longer to fire off,
Hmm.
but it'll be a bigger size, right? Because it's a higher conviction.
Yeah.
But of course, when you're wrong, you get hit
Yeah.
harder, right? And so we look at the variance of that strategy, and I guess it's kind of like volatility targeting. Like we will size the ones that have lower variance a little higher, and the ones with higher variance lower, because we
Yeah.
don't want one to dominate. And I would say one last thing, we have one sleeve that uses the directional, same thing, the signal, but we buy options, right? And
Hmm.
this is the one sleeve that's a long option. So we have kind of a long gamma component, and this is the reason you need risk management. We've seen these options go thousands of percent, right? Like in this particular strategy, look at the equity curve. It's like, I don't know, like a 20% win rate, and you're just bleeding and bleeding and
Yeah.
bleeding until you get a huge hit. And there was a day in April and one in last December where the market just sells off 100 handles in like an hour and a half, and you get massive, like
Yeah.
huge profits. And so you just think, oh yeah, if you're selling options and you're on the other side with no risk management, that's what you're on the other side of. So, but it's good when you're on the right side of that.
And then do you know what the total Greeks are across the portfolio? at each time? And are you looking at that of like, well, if this strategy fires and we go from positive gamma to negative gamma, and we don't want to be that?
We don't like I could look at my terminal and just like, oh, here's our grease, but it's not something we track. But what we know is that like, stop losses are just kind of a way of delta hedging, right? We're not
Right.
continuously delta hedging, but you can imagine if I sell so many puts and a bunch of them are marking at 200% loss, I'm picking up positive delta, right? And if I stop
Yeah,
those out,
exactly.
I've shifted my delta. So it's kind of a discrete way of delta hedging without specifically trying to hedge the delta per se.
I was going to say that before, even your concept of it, right? It's interesting having not come from the professional space, right? Like your concept of uh risk per credit, right? That's basically just assigning a delta to each one, right? Like
Sure,
a
sure.
pro would just be like, oh, my delta is X on this, and that's my risk, which is tied into, how far out of the money and all that. Zero DTE, right? So a lot
Yeah,
of
yeah.
everything you're doing in this one fund is zero DTE. That was hugely talked about sometime last year. I can't remember when. It's kind of
Right.
faded into the background. Nobody thinks it's going to blow up the whole system anymore. But let's just talk for a bit of like when you started getting into that, whether it was the retail or once you were running this professionally, and then what your thoughts are. Is it dangerous? Is it going to blow up the whole system one day? Is it totally fine? So we'll start with like, how did you first start getting into zero DT?
Yeah, so with my original fund, I mentioned we started with kind of the 7 DTE puts, and we were exploring different parts of the different tenors. So we actually first went up to higher 45 DTE and then 90 DTE. I talked about that. But then we started going backwards and we went to the 1 DTE and ultimately 0 DTE, which is like, it's intraday and it's like the same, again, applying the same concepts, but just at different tenors and timescales. And that was late 2019, like September 2019. We sold our first 0 DTE put. We actually didn't even do calls back then, but then we figured, hey, we can apply the same thing, sell calls. We just kind of did both sides. And it's funny because like COVID happened like shortly after, and then those are like really scary times. We were like VIX was so high. And actually, the concept of credit targeting was born then because we used to just do fixed contract size. But then
Yeah.
during March of 2020, the credits were humongous, which
Yeah.
is great. It sounds nice. You make a lot of money. But when you get stopped out, the losses are just so much bigger. Right.
Yeah.
And we
Yeah.
were like, you know what? Like, this doesn't make sense. If we want to kind of lower the variance, why don't we? And this is actually kind of counter to what most people that do options do, because with options you're taught to lean in when volatility is high because that's the opportunity, go bigger when volatility is high, right? We basically do the opposite. If my credit per contract is higher and high IV, I'm actually going to use that as an opportunity to either go further from the money or lower my size because I'm equalizing the pot of premium I'm collecting per trade. And
Yeah.
so that was kind of born then. um, but yeah, it was wild time. So we've been doing that since late 2019, and then of course, like it was 3 days a week, and then a big thing in 2022. Finally, like we got the dailies and all the volume going up, and even though I quote unquote manage money, like I've still kind of associated myself with the retail crowd, and I'm still engaged in these kind of online communities, and I know a number of people who've started like off the shelf retail facing automation, right? Specifically geared towards zero DT trading. And some of these have pretty large user bases now, and there's like two or three of them. And so I don't know the numbers specifically on like how much of the flow is like driven by retail versus institutional or whatever. I just see all these stats that like people keep talking about the volume going up. And of course, like the best people to talk about would actually be kind of like the Chris Citios or the Jim Carsons. So you've talked to them, and
Yeah.
a lot of my knowledge is kind of just from them. Like I'd just be
Yeah.
parroting what I've heard, but like it kind of makes sense about the whole idea of like there was this idea of the tail wagging the dog and the options complex and dealer, market makers hedging kind of driving the flow. I think Jem said like the relationship flipped. Like he was saying like options are the underlying now. Like he literally said like
Yeah.
that
Exactly.
that's
Yeah.
backwards. So again, I'm just parroting, whatever I say, I'm just regurgitating what I've heard from the real experts in that aspect. But
But it'd be so in terms of your own portfolio, though, and I think we've already covered this, I guess, but just the fact that you're using zero DTE didn't increase your risk, in your opinion, right? It's not like you're naked, and if the market closes down 20%, then your whole fund blows out, right? So I think
Yeah.
that's in people's mind that the just switching from even 30 DTE, and I'm going to start, do you ever listen to a Smart List podcast? And they talk about his sister Tracy in Wisconsin. So I'm going to start talking about my friend George, who listens to the podcast. So DTE is days to expiration for George. But so switching from 30 DTE to zero DTE didn't, or let's ask the question, did that increase your risk?
So the reason zero DTE was kind of interest and how it got, literally we spun it out to its own fund, right? We made a fund out of it was because of the lack of the overnight exposure. Now there's always trade-offs. So even going from one DTE where you take one gap to no gap, we're essentially day trading, if you will, the
Yeah.
options. So you lack that gap risk, but what you take on is the gamma risk, right? Because you're inherently going to be selling much closer to the money. That's just by definition, if you want to collect a reasonable amount of premium. And so there's that. And, you know, we understand, and I mentioned, you can't really properly hedge zero DTE because you can't do a Vega hedge. The market moves, you're already right there. So there's two kind of things. One, everything's spread off. We don't trade them naked. So they're spread off. So there's like a fixed amount that you can lose per spread, right? Just per unit of risk. And on top of that, like we just, you know, I know there's people who kind of use 80, 90% of their account, right? Because when you're doing spreads, right, even if you have portfolio margin, it's basically just a spread amount. Like you don't save any margin on
Yeah.
the portfolio. It's just whatever that amount is times the contracts at your risk, right? So we're not gonna ultimately size is the backstop, right? And you're gonna size it to an amount where you're not gonna blow up, right? You might lose a couple months of profit, but
Yeah.
who hasn't done that before, right? But again, size is the ultimate backstop. So like we look at it like, yes, you have stop losses, but that's your kind of primary line of defense, if you will. But in the case you can't rely on that, and actually, I talked with I think Chris Abdamasia, like he
Hmm.
refers to it as EMP risk, right? Like exchange goes down or you can't
Yeah.
execute. And so at the end of the day, the size is going to be the ultimate definer of your
Right. But
ultimate
that would have
risk.
been the same thing with 30 DTE, right? Like you're still doing the same calculations,
It's a
just
little
different.
bit different
Yeah.
because with 30 DTE, one, you can be further out of the money, but you can kind of structurally, okay, you know, we talked about with the 90 DT and the back ratios. Yes, those hedges depend on a large event and a large shock to hedge, but if that event does happen, you should be well hedged, right? So you
Yeah.
can conceivably come up with a structure that will react in a black swan event. What I was saying was with zero DTE, you
Like
really
there's no
can't.
market down there. Yeah.
Yeah, you can't structure something. There's no Vega, so that's the exposure is just gonna be that gamma. It's just full on.
Is
So
there a market down there if I wanted to buy a 30% out of the money zero DTE put?
the problem is
Is anyone selling those?
maybe there is, but here's the thing. Let's say I'm selling a put that's 1% out of the money, right? And I buy a put 30% of the money. the mar- since there's no time left, a market has to drop 30%
30%.
before you give.
Right.
So that's the difference with
Yeah.
the back ratio, right? You might be selling 10% out of the money and buying 20% out of the money, but you have 90 days left. So if the market even drops 10%, VIX goes to 80, you're gonna get a pickup from that ratio on the back.
Right.
That's the difference. You have that Vega component. You don't have that with zero DTE.
And what's the average like deltas you're trading these things? Are they like 80, 90? Like they're essentially, that's you said, you're day trading basically.
They're still out
You're
of the
almost
money.
day trading the futures, right?
Yes, but we're still primarily selling. We're not intentionally selling in the money or trying to get that full delta one exposure. So like depending on the time of day, we're probably gonna be anywhere from like 10 delta, 8 delta in the morning to late day, maybe 20 or even 30 delta.
Hmm.
But it's still we still try to
So we
get
even in
that
the
pro.
morning, 1% out is only 10 delta.
It depends on VIX and a lot of
Yeah,
things.
yeah.
Yeah, so,
But
something like that. Yeah,
oh,
it really depends. Depends on VIX. Depends on which exact kind of price per contract you're trying to collect. Like right now, it's 2 o'clock p.m. Eastern time here. I'm just taking a quick look. Like a 30 delta put. No, what is this? Like a 15 delta put. Yeah, this is 57.85. It's just like 20 points out of the money, right? SPX is
yeah.
5,800, so it's tiny.
Okay.
Yeah.
Yeah. And then do you in real time, do you feel that like binariness, for lack of a better term, right? It's like has almost no delta, and then all of a sudden it just flips to having tons of delta.
Of course. Yeah.
Yeah.
So
And
like
that's gamma, but yeah.
yeah, so we have considerations for that. Like we know strategies that trade earlier, you're gonna be further out of the money. You kind of know if you're like 30 points away and it's by the end of the day, like you're relatively safe. But like later in the day, you have to be trading very close. And so we're aware that statistically speaking, you're just gonna end up in the money more frequently. And
Mm-hmm.
so one thing I mentioned, like you talk about scaling strategies, like we won't lean as heavily into the strategies that trade late day, even though they look very profitable, because like theta is enormous. Like if as long as the market doesn't move, you're gonna make all that money in 5 minutes, right?
Yeah.
But if it does move, you lose a
You're
lot real quick.
gone.
So they look very attractive, but we know inherently there's that in the money risk, there's the liquidity risk. So we won't size that sleeve as big as we otherwise might have if you look solely at the performance.
Yeah. And to me, it's almost like flipping a coin at that point, right? Like if you
It
have
is. Well,
minutes left. Yeah.
remember, if you have a coin that's 50%, you make a buck 10, 50% you lose $1. Like you want to flip that coin as many times as you can. It's still a good
Right.
coin.
Which leads to me, like, do you think the exchange will wait? What are you trading? SPX options or
Yeah, we
futures
just trade
options?
just SPX index options.
Got it. Do you think they'll eventually go to hourly and minutely and right? They're for-profit exchanges. I think they're just going to keep cutting it as fine as they can
I don't know. They
until
might.
people start buying it. Yeah.
I've heard the rumors. I honestly I don't know how I feel about it, but we're doing automated stuff. We're already trading. And we do like a couple hundred trades a day. So maybe just instead of trading the one that expires at 4, will be expired at 9, 10, 11. Just a different
Yeah.
expiration. Who knows?
Let the computers hash that all out. So where do you go from here? What's next on the horizon? More research or let these strategies roll for a while?
There's always more research. Like we bring a strategy online like every 3 4 months, I guess. So there's like so much to explore. And last time when I was with Corey, he asked, for instance, like, will we explore other markets? It's kind of like the limitation for us is just the data, like, because
Yeah.
we always very thoroughly like test everything and validate everything. And even in SPX, like we've continued to find different ways of exploring the strategies, and a lot of it's just anecdotal, like, hey, today the market did this. Oh man, that sucked. I wonder what if we did that instead as a reaction. And of course, like, you know, you want to avoid curve fitting and cherry picking, and just you never want to develop a strategy
Yeah.
that's fixing a specific problem, but you can get a lot of ideas from the problems that you see. And so you just kind of see what sticks, and like there's all these different ideas that we keep trying.
Do
But
you
yeah,
ever
no.
worry that your sorry, to interrupt. Do you ever worry your
Mhm.
edge is your naivety almost, right? Not to offend you, sorry, but right, if that's your edge and you didn't know all these other things, and then as you learn them, you incorporate them in the model, and then you become just like everybody else.
So this goes back to what we were talking about earlier, where the factor or the edge, like you have to have a fundamental belief that that factor exists, that VRP is a thing, that trends and momentum based on behavior biases is a thing. Because if you don't have that is the first principle. Everything is just a iteration or build off of that, right?
Yeah.
And so I think as long as I have reason to believe those factors exist, and I think they will exist, like um there's the phrase from Jem O'Shaughnessy of from Infinite Loops. He says like human behavioral bias or something. It's like the last exploitable edge. I probably killed
Killed the
it,
quote, but yeah.
killed the quote, but it. And so I think there's a lot of meaning in that. So like as long as humans don't change and they're biased, they're gonna have kind of predictable behaviors, which lead to all of those other things. And
But that's
that's
funny because we're in the midst of AI, which is like designed to kill those biases and take them away, right? Or maybe
yeah,
it's
but
just
then
enhancing them. Maybe we're coding
that's what
the
I'm saying.
biases into the
Right.
AI.
People say someone has to code them, right? So like maybe it's just an extension of that.
Or if
So
they learn from the entire human history, which is just codified the biases.
right.
And do you use any AI in the research or the trading or anything?
At the moment, no. Like we have a couple guys who have some AI background, and we've looked at trying to look at different features and see if there's patterns, but I don't know. Like we haven't found anything, nothing actionable yet. Not
Yeah.
that we're opposed to it.
And it's weird, right? But get spurious correlations like, oh, always sell at 9:45 a.m. on Tuesdays. Like,
Yeah,
okay, why? Yeah, just because the AI said so. I want to know the reason.
exactly.
Uh, Great. What else? You got anything else you want to leave us with?
Um, I think the idea of kind of retail. I know like there was, especially a couple years ago when I had that appearance with Corey, like there's this idea. It's hard to disentangle the retail space in terms of the people who are just bull market geniuses. I mean, I see all these accounts of like trading the wheel or like selling puts, and I think that's kind of my indicator of like we're at the top, right? But
Right.
there's that part of the space, but there really is
And
like
they
kind of
started it like right after COVID. And they're like, this is easy. Yeah.
something like that, right? And then there is but there is another side of kind of the retail aspect, right? Retail, maybe they're not managing funds or part of large shops, but like there's smart people out there.
Yeah.
And it's something where like don't discount the little guy, you know?
Right.
Um,
Well, it's almost a large law of large numbers, right? Like if all of them are putting their minds to work, there's going to be some good stuff that comes out of there.
yeah, and part of that's because there's been this proliferation of data that's available not just to the big shop. Like you can just
Hmm.
go to Sibo shop and buy data, and like if you can code and you can process data, it's all about just big data, right? And there's off the shelf sophisticated back testing software, automation software. So yeah, it's just it's been interesting to be a part of that side of it and watch that space grow. And again, like that's kind of the side that still kind of associate myself with, even though I've quote unquote joined the dark side, if you will, like kind of managing
No,
money.
don't do it. Right. Until you have like a compliance team and biometric scans to enter your office and stuff, you haven't gone full dark side. So yeah,
Yeah.
you'll be good. Um, all right. Well, thanks so much, David. I think we'll leave it there. Tell everyone where they can find you, where they can listen to the podcast.
Yeah. So my podcast is called the Trade Busters. You should be able to find it on most of the major platforms: Apple, Spotify, Google Podcasts, and it's kind of an eclectic mix. It's retail oriented, options focused, but it has a mix of strategies, specific education on that. I've had a lot of guests in this space. I've really tried to broaden the horizon of like what it means to be a retail investor. So I've had people like Corey, Andrew Beer, Jerry Parker, and to kind of talk about different products. And now you can construct capital efficient, institutional quality type of portfolios with the products available and portfolio margin, and just like it's so accessible now. So that's kind of been my big drive, and kind of why I do what I do. And I have if you go to thetradebusters.com, that's kind of my quote unquote trading page, if you will. It's actually just a Google Sheets deposit. There's like this running joke that I've never made into a real website, but there's links to my podcast episodes, other podcasts, probably a number of your episodes that I really
Yeah,
like.
yeah.
It's sort of just like the repository of like stuff I like to share. It's kind of like Chris's The Moon Tower, but kind of my
Hmm.
version. Yeah.
I love it. I got to get Chris on here eventually, maybe in the new year.
Yeah, for
Um,
sure.
well, yeah, check that out. And then, so you started that when the podcast?
Wow, I started that like summer of 22, maybe.
Okay.
And it's like
Yeah.
130 episodes now. It's crazy. I can't even believe how much there is, but it just
Right.
kind of goes.
Right. you like doing it. You like the talking, the scheduling, all that junk is a pain in the butt. But the talking is the enjoyable part, at least to me.
Well, it's because I don't like to write. Like I actually linked. There's a handful of essays I wrote that were like pre the podcast, and just whenever I had something I wanted to share certain ideas. But I found like it would take me a month to write like two
Yeah.
paragraphs. It's just that's not my
Well,
MO.
jump on the AI. That's tailor made for you there, right? Just open a memo recorder and go on a walk, talk for an hour, and then have AI write
Well,
a summary on it.
well, that hop on a record and talk. That's basically how the podcast was born. So I figured
Exactly,
I don't
yeah.
like to write, so I just talk, and then so I can just sit there and talk for an hour easily, and then just so it's just kind of like miscellaneous thoughts, and that's how that started.
Love it. All right. Well, check out David. Check out the podcast. You got a website for the GP?
I not at the moment. Feel free if
Okay.
someone's interested, just reach out. You can find my contact info, the Google Sheets page, my Trade Busters emails there. So feel free to reach out. But let's leave it at that.
We'll leave it at that. All right, David. Thanks so much.
All right. Thanks
Talk
for
to
having
you
me.
soon.
It was a pleasure. Yep.
Love it.
Okay, that's it for the pod. Thanks to David. Thanks to RCM. Thanks to Jeff Berger for producing and RCM for sponsoring. We'll see you next week with Jason Buck and Zed Francis to close out the year. Usually we take off Thanksgiving to after January. So last pod of the year next week. Tune in. Peace.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.